Hi, today I want to talk about a very important topic in trading, risk management. In fact, to be honest, I believe that no successful trader can exist without proper risk management. Because in success, risk management and the right attitude, the right psychological preparation is about 80% of success. And only 20% of success is due to how well you analyze the market, the success of your strategy, and so on. And in this video, I'll explain why, specifically with numbers. Lack of risk management ruins a lot of newbies. I've seen so many of the newbies I work with. I see that they very often put 50-30% on each trade, no stop loss at all, and realize that unsuccessful trades will happen exactly depending on your strategy. They can be 40%, 50%, 30%. If you have a very good strategy, but they will anyway. And when you have a series of bad trades, if you mismanage your capital and your risks, you might just lose capital. It would seem that you have a 70-30 strategy. That is 70% of the time, you make money 7 out of 10 times. But if you have these 3 trades that are going to fail, and you have 30% risk on each trade, in this case, you will simply lose your capital, even though you are profitable and well analyze the market and understand everything clearly. So today, I want to talk about the 3 most important rules of risk management. This video is mostly for beginners, and many of these tips may seem trivial, but I see that even among experienced traders, not everyone uses it. So I think it will be useful for experienced traders as well. So the first rule is always use stop loss and take profit on every trade. For example, like this one here, we see that we have a falling trend. We expect a continuation of the falling trend after the correction. For example, let's say in this trade, we expect the price to go further down. For every trade, we should have a target at which we are waiting for the price and a stop loss. Insurance in case the trade does not go according to our plan. So profit and stop loss are orders that close your trade automatically. You can open a deal, set take profit, and stop loss and just walk away from the terminal. The deal will in any case close upon reaching your chosen target. We can usually show that way to show that our target, right here, mark it in red because it's a buy deal. Our target is right here. We're going to take profit here at this price. Our stop loss is at about this level. If the price, let's mark it in green. That's our target right there on this trade down. If the price reaches this point, the trade will automatically close with a profit. But we also set up insurance at the same time. If we have analyzed the market incorrectly and the price does not go further, it will automatically close at this price with a small minus. This is your insurance in case you predicted the market incorrectly. Both take profit and stop loss should be mandatory for every trade. In order to set them, you need to go to the trade management menu, click the take profit and stop loss checkbox, and specify the specific price at which you want to set a stop loss. For example, right now the Bitcoin price is 105,000. We can look at the charts to see at what price we need to put a stop loss. That's 105,100 is our profit target, and the stop loss is at 105,140. So if on our trade down, the price reaches this mark down, we make money. And if it continues to rise and touches the 105,140 mark, the price will automatically close upwards. The deal will automatically close with a stop loss. That was the first rule. On each deal, we must have a goal. This is take profit and insurance against sharp price movement, stop loss. Now let's talk about the proper ratio between the stop and there. Ideally, let's just give you an example. Not from trading, from business. What kind of deal would you take? Let's say you invest in a project and you have an opportunity to earn $10,000 on that project, but you can also lose $10,000 on this project. That's the first option. In the second option, you have a project that you can invest $10,000 and earn $30. Naturally, you as an investor are more attracted to the second option, that your goal, your potential goal, should be higher than the funds you are risking. That makes sense. And the better this ratio is, the better it is for you as a trader. Same in trading. When you in the market see a good opportunity, such as here to open a trade up, you should set a target that is bigger than the risk you're taking. That is, the ratio between profit and stop loss should be at least 1 to 2. This rule will help you earn even in very bad periods. Because if you set a target twice as big as the money you're risking, you can, even if you have 50-50 positive and negative trades. If you just randomly open those trades, you're still going to be on the plus side because you're making twice as much on each winning trade as you're losing on a losing trade. You can even have 35 to 40% and you will still be in the plus side because every trade in the plus side brings $200. And for every negative trade, you lose $100. And ideally, this ratio can be even better than 1 to 2. You can try 1 to 3, 1 to 4, and so on. Of course, the higher the ratio, the more often the stop loss will be triggered, simply because it stands closer. It's more likely he'll make it here. But if you combine this with your technical analysis strategy with good prepared entry points, you can achieve a 40 to 50% win rate, which will give you a huge increase in profit if you have the right ratio between take profit and stop loss. It should be at least 2 to 1. And the third rule, on each trade, we risk no more than 10% of the capital. And 10% is a pretty aggressive strategy. It is better to allocate about 5% of capital to each trade. That is, your stop loss should be no more than 5% of your capital. Let's say you have $1,000 in your account, so should be at a point where you won't lose more than $50 to $100 max for that trade. 10% is the maximum value, and it is convenient to set it. You can set 10% on this scale, and it will automatically recalculate the trade size according to your capital. Those are the 3 simple rules of risk management. Managing risk, managing money both in business and in rating is very important. This is far more important than what strategy you choose, and all these rules can be combined with any analysis strategy you use, with any indicators, with any news, fundamental factors, analysis of reports, and so on. You always need to think about the risks. You always need to have insurance and a target on every transaction. And always, this level of risk should be acceptable to you so that even a series of unsuccessful trades will not deprive you of most of your capital. Be sure to apply these rules to your trading.